The latest jobs report sends stocks on a wild ride. I'm Lisa Bernhard with Reuters, and I'm joined today by Anna Rathbun. She is Chief Investment Officer at CBIZ. Anna, February's non-farm payrolls report came in today from the Labor Department. On the one hand, job growth accelerated. So did the unemployment rate. What are the most important data points here to look at to tell us which direction the labor market is headed?
When you have a report like this, every number feels like it's important. This was actually admittedly a very confusing jobs report, but I would lean to the side of softness. First, you do have a beat for February, but you have a heavy revision down in January from 353,000 jobs to 229,000. And of course, as you mentioned, you have a tick up in the unemployment rate, and that is a 2-year high. And also, the pattern of hiring is that it's concentrated really in sectors that are very much seen as defensive, like healthcare and education and government. And to be honest with you, that was about 50% of the new jobs were in those defensive sectors. So I would say this jobs number, even though it is a beat, it doesn't really reflect an economy that is roaring. We're growing, we're adding jobs, and job numbers are high, but does it promise a roaring economy ahead? I would put a little doubt on that.
What about wage growth? Because that, in terms of inflation, is something that the Fed has been looking very closely at.
So the wage growth at 4.3% is admittedly high, and the Fed definitely cares about that. But you have to pair these numbers with other data points. So if you look at the JOLTS number, which came out earlier this week, you will see that the quits rate is really low. I believe it's below the pre-pandemic levels now at 2.1%. Now, quits rate is important because when you leave your job for a new one, that's often what triggers a large wage growth. So if people aren't leaving their jobs for a new job with a higher pay, that wage growth is probably going to come down. So going forward, it looks like there's a cap on that number as well. So, will the Fed cut rates soon? As Powell said, there probably would be a reason to cut or start cutting sometime later this year.
So let's pick up on that point that you just mentioned. Given Powell's testimony this week in front of Congress and with this jobs report, when specifically do you think the Fed will start cutting rates?
So our position has been that the Fed will most likely cut rates maybe earliest by June, probably the second half of the year. And then it gets a little bit tricky with the election happening with a lot of noise around. But if we're looking at the Fed's favorite measure of inflation, which is the PCE deflator, month over month, annualized for the last 6 months, we're averaging about 2.3%, and that is pretty close to 2. And Powell said that they're confident to cut rates as long as they're moving toward 2%. So we don't have to see 2% for them to start cutting rates. And so I think we're pretty close.
Stocks have whiplashed since the jobs report came out today. First, they rose, and actually the S&P and NASDAQ hit intraday highs and then completely plummeted. So are investors completely confused over this report, or what else is going on?
Well, so I think the investors, the markets actually saw the softer side of the job market. And that means, maybe an earlier cut for the Fed or more cut for the Fed. And that juices up the markets. But what's making the markets fall intraday is really individual stock story and an expensive multiple story. So I'll mention two stocks in particular. One is Costco that missed revenue estimates. We all love Costco. I love Costco. And there's a lot of footprint, and everyone's excited about Costco, but the multiples are high, which means expectations are high. So when expectations are high and when you have this kind of a miss, you do tend to get punished. The other one is Broadcom, which also missed revenue expectations just for its semiconductor business. So you're seeing semiconductor section of the S&P 500 sort of sell off. And with the run up in tech in the last year to a quarter, they have a higher weighting in the S&P 500. So any weakness in that area of the market is going to drag the index down lower.
Okay, let's talk a little bit of politics because we're coming off of President Biden's State of the Union address last night. So we are obviously a highly polarized nation, and it seems like this election will come down to swing voters. How do you think they feel right now? Broadly speaking, maybe this is an impossible question, I'll ask it anyway. Do you think that they're feeling richer, poorer, more optimistic if the economy is in fact their number one priority over other issues?
Well, it depends on who you are. If you're a high earner and you've been able to accommodate all of this inflation, and by the way, inflation falling doesn't mean prices are falling. Inflation falling just means prices are going up more slowly. So if you are observing the world around you, food prices are remaining high, if not going up still. And that doesn't make you feel that great. And if you're a high earner, you can accommodate those high prices. You might be okay and you can have the luxury to think about other things. But if you're not one of those people, then you're going to feel differently. And so, 3.9% unemployment rate, historically low and really strong, but that's not going to feel like your situation, right? 3.2% GDP growth, which was the print for fourth quarter last year, that's not going to feel like your life. So when we're talking about the economy, we tend to talk in really high levels. And from that perspective, the statistics look good. But from a voter perspective or individual perspective, things are not looking that great. Sentiment, consumer sentiment, there was a surprise downward at the end of February where people who are saying jobs are hard to get are going up. Jobs are plentiful or going down, and there will be more employment in 6 months. Those hopeful people, the numbers are also going down. So there's clearly a shift in the consumer sentiment. And if this pattern continues, this trend continues into the second half of the year, I think it'll be definitely an interesting election process toward November for President Biden.